President Trump has officially returned to the White House. We're going to look at the key aspects of the inauguration speech before we turn to the UK and some important data on the health of the labour market. President Trump has officially returned to 1600 Pennsylvania Avenue. In the inauguration speech yesterday, he alluded to a string of executive actions which include cutting immigration and ending international wars, to raising the tax and the tariffs on the import of goods into the United States to protect the US economy and to reduce the taxation for households and to businesses, to expand American territory and to expand energy production, to drill, baby drill. In the markets were actually closed in the US for Martin Luther King Day, but what we did see is the dollar, which weakened by 1%. The dollar's been on a real rally over the last 4 months, really on the basis of the tariffs which are expected to be imposed, which are expected to have an inflationary impact, keeping interest rates higher for longer in the US. We heard from Trump's administration that they would first look to review international relations with China and with Mexico before enacting tariffs. A result of this was the dollar weakened. Equity markets, in terms of the futures market, held onto the gains which we saw through the course of last week. Over the coming weeks, we're going to get a bit more clarity in terms of exactly what policies are to be imposed under the Trump administration. That's going to end a lot of the current uncertainty which we've seen within markets, which has been driving a lot of volatility. And we'll see this as he really pushes to make his mark in the first 100 days in office. We're also going to hear this week from the big boys of corporate America. We're going to hear from American Express, Procter & Gamble, Johnson & Johnson, Netflix and Charles Schwab. If we look at financials, technology and consumer discretionary sectors, these are expected to be some of the strongest performers in terms of the earnings, the profits, which they're going to report in the fourth quarter of last year. Currently, the basket of US companies is tracking on earnings growth of 12.4%, which is a very strong level indeed. So we'll provide further updates through the course of the week on earnings reports. Closer to home, in the UK this morning, we've received an update on the health of the jobs market. If we look at regular pay, which strips out bonuses, we've seen an increase of 5.6% in the 3 months to the end of November, and that's up from 5.2% in the previous read. This has run ahead of the current rate of inflation, so you're seeing wages which are outpacing the current level of inflation which we're seeing. Vacancy rates have actually fallen. They're now below the pre-pandemic levels, and that's demonstrating that the heat which came into the market after the pandemic has really came off, and where we've left with is a much stronger base. The UK labour market is in a very resilient position. That actually presents a bit of a challenge to the Bank of England, who are looking to bring inflation down towards the 2% target. If we look at the current interest rate expectations and how they're evolving on the digest of all of this information, the market currently expects 0.75% worth of interest rate cuts in the UK this year. That would take interest rates to 4% by the end of this year, with the first or the next interest rate cut coming through in February of 0.25%. A number of important dynamics coming through there in terms of policy, in terms of the economic landscape which we're seeing here in the UK for earnings and the health of corporate America. Thank you for watching. Please do tune in tomorrow here on Morning Markets.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.